China's currency devaluation continues to impact economies around the world, including Australia's. The country's struggling stock market has taken a hit, but some experts say the lower yuan could end up having some positive effects on the Aussie economy. Greg Navarro explains.
Bei He divides her attention between the inventory that fills her Sydney warehouse and the falling Aussie dollar, which is now hovering around 73 US cents.
That's just not very good for us because it means we buy everything more expensive.
But the outlook here is much brighter because the furniture that fills her showroom is imported from China, where the value of the yuan has dropped.
The product we bought from China, the price can be cheaper. So that's really good for us. So we will have a little bit of power to negotiate the price with the factory in China.
Australia has felt the effects from China's currency drop this week across its economy. One of the most immediate impacts was a hit to the Aussie share market, and in particular, commodities.
Been a growth rate in 2007 now to 7%, and now the market's pricing in a below 7% growth rate now in terms of even weaker demand than initially thought.
Put the dollar to a 6-year low this week, and it's expected to slow foreign investment in the country's property market, especially from Chinese buyers who will now find property more expensive. But University of New South Wales economist Tim Harcourt says the longer-term impact from China's currency devaluation is much more positive.
It will mean a stronger Chinese economy, and that's ultimately good for Australia as the number one trading partner.
Bei He is still keeping a close eye on the Australian dollar, but she says the prospect of cheaper imports from China will make that watch a lot easier. Greg Navarro, CCTV, Sydney.